On the morning of September 15, 2008, a bank that had survived 158 years simply ceased to exist. Lehman Brothers filed for bankruptcy, carrying around $619 billion in debt. It remains the largest bankruptcy filing in United States history. World Wars and the Great Depression. What it did not survive was the housing boom it had helped to inflate. To understand how a giant of Wall Street could vanish in a single weekend, you have to go back to what once made it feel invincible. Lehman Brothers began in 1850 as a humble general store and cotton trading business in Alabama. Over generations, it grew into one of the most powerful investment banks in the world, a fixture at the very center of American finance. By the 2000s, it employed roughly 25,000 people, and its headquarters towered over the heart of New York. At the top stood its chief executive, Richard Fuld, known on Wall Street as the gorilla for his aggressive, competitive style. Fuld had run the firm for years and had steered it through earlier storms. Inside Lehman, confidence ran sky high, and in the middle of that decade, there was one business that everyone on Wall Street wanted a bigger piece of: American housing. In the early 2000s, home prices in America seemed to only ever go up. Banks handed out mortgages freely, including to borrowers with weak credit, so-called subprime loans. On its own, a single risky mortgage is a small gamble, but Wall Street had found a way to turn thousands of them into a product it could sell. Banks bundled huge numbers of home loans together and sliced them into securities that could be sold to investors around the world. These mortgage-backed securities were rated safe, and they were hugely profitable, as long as ordinary people kept paying their home loans. Lehman Brothers dove in deeper than almost anyone. It did not just sell these securities. It bought and held mountains of them, and even purchased mortgage lenders of its own. To place bigger bets, Lehman borrowed heavily. For every dollar it truly owned, it had borrowed many more. On Wall Street, this is called leverage. Leverage is a magnifier. While housing rose, borrowed money multiplied Lehman's profits. But if housing ever fell, that same leverage would multiply the losses just as fast. It was a bet that only worked in one direction. As long as home prices kept climbing, the borrowed billions looked like brilliance. Almost no one at the very top seriously planned for the day housing might fall. There was a second problem hiding in plain sight. Lehman was carrying an enormous load of debt, and too much visible debt could frighten the investors it depended on. According to a later court-appointed examiner, Lehman used an accounting maneuver known as Repo 105. Near the end of each quarter, at the very moment it reported its finances, Lehman temporarily moved about $50 billion of assets off its books, treating short-term loans as if they were outright sales. For a few days, at the exact instant it was measured, the firm looked less indebted and safer than it truly was. Then the assets quietly came back. The examiner later concluded this made Lehman's balance sheet look healthier than reality. Importantly, no top Lehman executive was ever criminally convicted over the collapse. For years, the machine ran beautifully. Then, in 2007, American house prices stopped rising and began to fall. Subprime borrowers started defaulting on their mortgages. Suddenly, those safe, profitable securities were worth far less, and no one was sure exactly how much less. Lehman was sitting on vast piles of exactly these souring assets, with heavy exposure to real estate. In March 2008, a warning shot rang out. Rival investment bank Bear Stearns nearly collapsed and had to be rescued in a fire sale backed by the Federal Reserve. Wall Street looked around and asked a simple, dangerous question: who is next? Many eyes landed on Lehman Brothers. Its stock began to slide, and short sellers bet heavily that it would fall much further. Lehman insisted it was healthy. Fuld fought back in public and searched for fresh cash and for partners who might steady the firm. Through the summer of 2008, Lehman tried to raise money and find a buyer. Talks were opened with investors abroad, but nothing closed. As losses mounted and confidence drained away, the clock was running out. By the second week of September 2008, Lehman's situation was critical. Its stock had collapsed, and the lenders it relied on were losing their nerve. That weekend, top bankers and government officials gathered at the Federal Reserve in New York for emergency meetings. Lehman's fate would be decided in a matter of days. Two possible rescuers emerged. Bank of America and the British bank Barclays each looked hard at buying Lehman. But this time, unlike with Bear Stearns, the United States government refused to put taxpayer money behind a deal. Bank of America walked away and instead bought another troubled firm, Merrill Lynch. Barclays was willing, but British regulators would not approve the rescue in time. One by one, the lifeline snapped. There was no buyer and there was no bailout. In the early hours of September 15, 2008, Lehman Brothers filed for bankruptcy protection. 158 years of history ended in a single filing. The images went around the world. Stunned employees walked out of the Lehman Tower carrying their careers in cardboard boxes. Roughly 25,000 people lost their jobs as the firm was broken apart and sold off in pieces. But the real damage reached far beyond one company. Lehman was wired into the entire global financial system. Banks suddenly stopped trusting one another because no one knew who else was holding fatal losses. Lending between banks froze. Credit is the oxygen of a modern economy. As it seized up, the panic spread from Wall Street to businesses and families everywhere. The day after Lehman fell, the giant insurer AIG needed an emergency government rescue to keep it from dragging even more of the system down. Stock markets plunged around the world. What had started in American housing was now a full-blown global financial crisis. To stop the bleeding, the United States government soon launched a rescue program worth hundreds of billions of dollars to prop up the banking system. Millions of people around the world would lose jobs, homes, and savings in the deep recession that followed. And what happened to the people who had run Lehman? Investigations dragged on for years, and Lehman's accounting was heavily criticized. But no top Lehman executive was criminally convicted for the bank's collapse. Richard Fuld, once one of the most powerful men on Wall Street, walked away from the wreckage as a lasting symbol of the era's excess and risk-taking. Lehman's fall changed the rules. In its aftermath, governments demanded that big banks hold more real capital and take on far less reckless leverage. In the United States, a sweeping new law reshaped financial regulation, an attempt to make sure no single failure could ever again threaten the whole system. But the deepest lesson is older than any law. When an entire industry convinces itself that prices can only go up, it quietly builds the disaster that proves it wrong. And still fall in a single weekend, once the borrowed money runs out and the trust disappears. Trails for more true stories of money gone wrong.